Welcome to This Explainer. So, you know the traditional American Dream playbook? The one we've literally all been taught since childhood? Well, it's mathematically broken. Today, we're diving right into the data to figure out exactly why the old rules of wealth building are failing so spectacularly, and, more importantly, what we can actually do about it. Seriously, why is it mathematically impossible to save your way to wealth today? For generations, the formula was super simple. Get a good job, stash 10% of your paycheck in the bank, and eventually retire comfortably, right? But sticking to that exact formula today has become a guaranteed path to financial failure. So what on earth actually changed? Here's our roadmap for This Explainer. We'll start with the grand American illusion, move into the broken math, uncover the silent wealth killer, explore the barbell economy, and finally, lay out the modern wealth blueprint. Section 1. The Grand American Illusion, Uncovering the Debt Trap. We all know those classic visual markers of success, right? The beautifully manicured lawns, the shiny $60,000 trucks in the driveway, the photos of amazing vacations. But here's the thing. They mask a highly fragile reality. If you look closely at these households, you rarely find deeply rooted wealth. Instead, you find a system where even two-income, highly educated families are barely keeping their heads above water. They're essentially living just one medical emergency or corporate layoff away from total financial ruin. In fact, the American middle class is essentially on life support. They're hooked up to a machine fueled entirely by high-interest credit card debt, predatory auto loans, and massive 30-year mortgages that just gobble up half of a household's take-home pay. So what you're seeing in the suburbs, it's not actual wealth. It's highly leveraged consumption. Section 2. The broken math. The 1970s versus today. Okay, let's look at the numbers, because the contrast between 1970 and today is absolutely stark. Back in 1970, a median home cost around $24,000. That was roughly 2.7 times the median income of $8,700. Fast forward to today. While the median income has crawled up to roughly $75,000, the median home price has absolutely exploded to over $420,000. That means a house now costs nearly 6 times the average annual income. And in hyper-competitive markets, you're looking at 8 to 10 times the income. The basic math for the average worker simply no longer supports buying the core pillar of generational wealth. And man, it's not just housing. The climb in higher education is even steeper. Back in 1980, you could cover tuition, room and board at a public university for around $2,500. Today, get ready for this. You are looking at up to $80,000 a year for private tuition. No way, right? Welcome to the student debt trap. We are literally watching an entire generation take on $40,000 to $100,000 in student loans, often at around 7% interest, all just to qualify for an entry-level job that might only pay $50,000 a year before taxes. This isn't a solid career path anymore. It's a financial hamster wheel, totally designed to trap individuals in debt before they even earn their very first paycheck. Section 3. The silent wealth killer, the structural debasement of the US dollar. So, how does wealth just vanish invisibly? Well, the massive expansion of the money supply actively dilutes the value of every single dollar sitting in your savings account. Since the Federal Reserve was created back in 1913, the dollar has lost over 96% of its purchasing power. But 2020, that's where things went into absolute overdrive. The United States literally printed more money in a 2-year window than it had in the first 2 centuries of its entire existence. That is wild. So where did all that printed money actually go? This happens because of a vital economic principle called the Cantillon effect. And honestly, it's essentially a hidden secret of the wealthy. It means that the closer you are to the printing press, think big banks, hedge funds, and the ultra-wealthy, the more you benefit. They get their hands on the new money first and use it to buy up scarce assets like real estate and stocks. By the time that money trickles down to the average worker, prices for food, housing, and healthcare have already skyrocketed. Inflation acts as an invisible tax that rewards asset owners and ruthlessly punishes salary earners. Section 4. The barbell economy, the evaporation of the middle class. Now, as if inflation wasn't enough, unlike past decades where automation primarily threatened blue-collar factory jobs, this current wave of highly efficient AI automation is coming straight for college-educated middle management roles. Jobs that used to guarantee a really safe, comfortable lifestyle, we're talking legal assistants, financial analysts, accountants, and even software engineers, are now highly vulnerable to algorithms that can streamline overhead costs by 40% overnight. Because of this, we are rapidly shifting into what's called a barbell economy. Imagine a giant barbell where the safe, comfortable middle is just completely evaporating. What you're left with are two extreme ends. On one side, you have high-leverage asset owners and elite technical specialists who control the capital. And on the other side, low-wage service workers performing physical jobs that AI simply cannot replicate.
Section 5. The Modern Wealth Blueprint. Thinking like an asset owner.
Okay, now that we've outlined the problem, here are 3 crystal clear rules to help you stop acting like a consumer, playing a game you are destined to lose, and start executing the strategy of the top 1%. Let's break down these 3 steps to surviving and thriving in this new landscape.
Step 1 is to protect your purchasing power. You do this by trading depreciating cash for scarce, productive assets that outrun the printing press. Holding massive amounts of fiat currency in a standard savings account is a huge mistake when true inflation far outpaces the measly interest you earn. Instead, the focus should be on hard assets. This means income-producing real estate that provides actual cash flow, equities in companies that have the power to raise prices during inflation, and decentralized assets like physical gold or Bitcoin.
Step 2 is all about building leverage. In the old economy, having leverage meant managing large teams of people or needing millions of dollars in capital. Today, new leverage, specifically code and content, is completely permissionless. It costs $0 to replicate. That means a digital product, a media channel, or a piece of software can be consumed by hundreds of thousands of people globally while you're fast asleep. Relying on a single employer for your entire livelihood? Yeah, that's just no longer safe.
Finally, step 3 comes down to understanding the absolutely critical difference between destructive debt and productive debt. Consumer debt, like maxing out credit cards for clothes or taking on high-interest car loans, might make you look rich, but it actually keeps you poor. Asset owner debt, however, involves using low-interest loans to buy assets, like apartment buildings, where the tenant's rent actually covers your mortgage. In this scenario, debt isn't a trap, it's an accelerator. The economic landscape has fundamentally shifted, and hoping politicians are going to fix inflation or that employers will hand out massive raises is just wishful thinking. The divide between the assetless class and the asset-owning class is widening every single day. So the real question is, are you going to keep playing by the old, broken rules, or are you going to take control of your financial destiny? Which side of the line do you want to stand on?